Hi, everyone, and a very warm welcome. The last 1 year has seen it all: a health crisis, an ailing economy, robust capital flows, and strong capital markets. And in this, speaking specifically in India, contrary to popular beliefs, it is the mid and small caps which have stole the show. To discuss the various nuances of the mid cap companies, we have with us our subject matter expert, Mr. Shreyash Devalkar. He's a senior fund manager with Axis Mutual Fund and has over 18 years of experience in this field. For the benefit of our investors, I would like to highlight the fact that Shreyas is one of the few fund managers who manages both the blue chip and mid cap fund with equal consistency, and his funds have been featuring in the top quartile for a very considerable period of time. Thanks, Shreyas, for taking out time for us and speaking to our investors.
Thank you for inviting. Thanks.
So, Shreyas, my first question to you would be on the market structure composition. Now, more than 80% of the market structure, if we look at the BSE 500 indices, belongs to the large cap companies. Now, we would like to understand from you that do you think that this Pareto principle is going to continue, or do you envisage a situation wherein the weight of top 100 companies could reduce by 10 to 15%?
That weight of large companies increasing worldwide. Actually, you also highlighted that well in S&P also same thing has happened. Probably they are around 24-25% of high companies. This thing happens more because some of the companies always tend to outgrow others. So there can be a GDP linked story, which are GDP plus minus 5-10% here and there. Those kind of stories are the rest of the stuff. While if you notice in any market in India or even in US, the stories which comprise a big chunk of market cap, they have outgrown the typical GDP growth parameters, and despite ups and downs in GDP growth, irrespective of GDP growth, they would have done better. And the reasons are sometimes different. So in case of, especially when you look at in US, probably Microsoft earlier was only in the computer space, and now they are leading company in a cloud. That kind of orbit change for any company, that leads to that substantial market cap creation. And there are similar such stories that the orbit change for a company from one level altogether to the different level, that leads to this substantial market cap gain for them, and such companies taking or stealing the show. In India also, the same thing has happened. Whichever companies would have shown growth irrespective of or compared to or very high growth compared to the broader economy, those companies tend to get that largest market share. And somehow those companies always have been few at any point in time. The company's name may change. So probably in 2000s, it would have been IT industry. Then in last in 2001 to 2010, at a point in time, infra as a space gained a lot of limelight. Uh, uh, then in this decade, the financial services got that limelight. These are the underlying principles why it happens. So the names of company may change, but these things somehow have happened always.
Right, Shreyas. I think you made a very
And
yeah,
and
sorry.
on the contrary, if you notice mid cap indices, they are more diverse in nature, because again there are many companies, and not the wider indices. There not many company would have outgrown their earlier orbit, and that's where when they grow, they get out of it and get into the large caps, and that's how probably the mid cap index don't show that kind of concentration the way large cap indices show.
Shreya, I think you got a very important point that it is companies who change their orbit and who resort to doing things differently are the ones who are the key beneficiaries. Now, the common perception always is that whenever there's a crisis, resort to large cap companies, resort to blue chip companies. Now, even if I go back to March 2020, most fund managers, most advisors were advising to stick to these companies. Now, given where COVID is, who, in your opinion, stands to gain the maximum from the change in structure that has happened over the last 1 year? It is whether it's going to be the large cap, the mid cap, or the small cap companies.
See, this crisis actually has led to separation in couple of counts. Whether it is large cap, mid cap, or small cap, the companies those are debt free, they outperform. Those who were with high debt and they somehow reduce their debt, they outperform. And lastly, and more importantly, the companies which have shown very good margin profile and free cash flows, they outperform. And across the board, it can be cement sector or pharmaceutical sector or IT, or you take any sector. There are many companies which have shown margin expansion as well as free cash flow generation, which is actually higher than the previous year. So irrespective of market cap, so at least my observation is this irrespective of market cap, the wider set has contributed to this outperformance and they have participated in this market. And actually the set which used to outperform earlier, which is financial services, that has underperformed. So what happens is when, if you notice, 40% of large cap is or Nifty is around roughly is financial services that has underperformed. While in mid cap and small cap index, that proportion is very less. So in mid cap index, that proportion is 20%, even after this rise in the market. So this financial services underperformance is also has also led to this differential in the indices of performance. So earlier, pre-COVID, financial services used to outperform hands down to the rest of the economy, and that's where the representation of that was more in the large cap, and Nifty ended up outperforming everyone else. While in last 1 year or so, because the concerns over asset quality to the growth. So the financial services used to be again highest growing sector. So credit growth used to be in high single digit, and retail credit growth used to be in 13%. So the retail credit growth story led to the financial services outperforming, and especially most of these are in that large cap category. And those companies outperform, and that's how the large cap as the index you got that their weightage is also high, and that those indices outperform. While in case of mid cap indices or small cap indices, that proportion was not there much, and somehow those companies, whoever was there in that retail credit story, somehow they faltered to do it with proper risk assessment. And these are the reasons why optically there is a large versus mid divergence having in last 1 year. And in this actually what I'm observing is not just to take from the bottom of the market, probably after the fall in March, and then look at it the returns now. The right way to look at I would also look at it, and I would suggest everyone to look at it, is from the peak of 2020, that was somewhere in Jan, till now what has happened. Then during that time also mid cap has outperformed, but again at least half of the attribution goes to this fact that financial services has underperformed during this time. And the rest goes to whatever observation I told you, that many companies showed a very good numbers, probably. And the underlying factor again for the better number, in my opinion, is also to do with organized versus unorganized. Most of the listed companies are are the organized part of the market, and the unorganized part of the market, which you must have heard always often used term nowadays, is K-shaped recovery. So somehow the organized part was in that upper leg of the K, while the unorganized part was in that lower leg of the K, and that's how the difference would have come, and that's where most of the companies did well.
So, Shreyas, I'll just take cues from this answer of yours, and address two important points that you mentioned. One was about deleveraging, and second was about margin expansion. In my next two questions, so we have almost seen a V-shaped recovery, not just in India but also globally, and two of the most important factors that have contributed to it definitely could be large relief packages and lower interest rates. Now, as we speak, we see a clear indication that, there could be a reversal as far as these factors are concerned. We are already seeing RBI draining some amount of liquidity from the system, and we also kind of getting a feeling that, there may not be steep rate cuts further. Now, you did mention that, most of the companies who did well are the ones who were on the path of deleveraging. But generally speaking, from, the larger universe of mid-cap companies, do you think that, a halt in the interest rate cuts, could that act as an impediment in the growth of this particular category?
As far as individual companies' balance sheet and growth is concerned, as I was highlighting, most of the stocks which would have, or most of the companies which have performed very well on the stock market, have that character of best balance sheet and good ROE levels. So interest rate moving up per se doesn't hurt them from their financials perspective. How interest rate, or even the other factor you alluded to, was the stimulus probably being rolled back. At least that as of now there are no indications, but whenever it gets, uh, the impact is more from the external side and not from the internal company side. One is, whenever we talk about the interest rate, so last decade, there was the interest rate downward cycle. Probably in between it went up and went down, but broadly it were moving down. At least in India, we have seen the transmission of the interest rate happening now, and now probably the interest rate for housing are as low as in sub 7%, which was never there in last entire decade, right? So where it hurts is, one, what helped the valuations, or what always helps the valuations when the interest rate fall, is lower interest rate is equal to higher valuation. That is the basic concept of valuations, that it is inversely proportional to the interest rate. So interest rates were falling, the valuations were moving up. Once in this process, at various point in time, it was earlier during taper tantrum, it was in 2013, somewhere in 17, 18 also. When the interest rate tend to move up, the simple theory of lower interest rate is equal to higher valuation takes a halt, and suddenly then you think that now you can't take the valuations up, and that caps the valuations for the stock. So that is the one from the valuation point of view or stock market point of view. And that's where you will notice that probably in this calendar year, Nasdaq has underperformed Dow. One of the underlying reason is this, that now how can you take the valuations up? There has to be beating on the earnings, right? So this is one part of it. The other part of it, higher interest rate or the stimulus being lower, is whether always what happens is, in the economic recovery, your growth starts, then inflation goes up, and then interest rate goes up. So this is, the horse is growth and the cart is interest rate, right? Now, if the cart moves ahead and horse is left behind, so growth doesn't come while the interest rate moves up. So in that scenario, obviously, if the company is in the capex segment, or if the company is in the segment where where you take just a case of auto only, right? When demand has not revived, at that same time, fuel prices are high. At the same time, if interest rate moves up, at that time, obviously, the demand for these companies, auto companies, will not be high. And in that case, whoever are dependent on them, maybe auto ancillary and mid cap or whatever companies, in such scenario, what will happen is, the horse is behind and the cart is ahead, and then suddenly the demand growth is not there. So whether financially these companies are weak, probably not. Most of the even the large cap and mid cap segment in the auto segments are financially actually clean nowadays, the way compared to the way it used to be earlier. Because in last cycle, many of these companies acquired both globally and locally, and those had led to the heavy balance sheet. And in last decade, everyone has learned this, and then no one has done any mistake in last 1 year, no, sorry, last 1 decade. And that's where you are seeing the balance sheets are clean. So from that point of view, you will not see any problem. But from the recovery and the growth numbers point of view, there can.
Right. I think that was a very interesting analogy, Shreyas. A question before I hand over to Harsh would be that, we have seen a phenomenal quarter as far as earnings is concerned. I think it is the best quarterly earnings in the last 24 quarters, if I'm right. Now, if we dissect these numbers, there has been no sales growth, but the profit after tax for these companies has been increasing. And this is a data I'm taking from a research report released by Axis Capital. Now, considering the fact that we are witnessing higher input cost, higher commodity prices, etc., do you think in an event where these companies will not be able to pass on the cost to the end user, the scope of earnings expansion could be limited, and it could just go away faster than we expected it to end?
Yeah. So here a couple of things one need to keep in mind. Why these companies showed good numbers, right? The basic important parameter what I highlighted was in last decade, no corporate went into the expansion spree or increasing the balance sheet size. Eventually, what happened? There was no capacity creation, and this crisis, what it led to. So there were no excesses, neither in the credit quality. Basically, there was no excess credit growth because corporate credit growth was actually weak. So corporate were not leveraged. At the same time, there were no excesses in supply side also. That is, no new capacities got created. So what it did during this pandemic situation was because of the supply constraint, which generally this pandemic actually accelerated, and that actually led to the organized player doing well. And that's what highlighting in my earlier answer as well, that you are seeing that the margin expansion, good free cash flow generation, that has been the case everywhere. So because there is no overcapacity in the system, so everyone has got could do that. Despite probably demand may not be as good as what you are suggesting. So now here are two things, whether it will continue. So obviously we have seen the best of the margins, and as you're highlighting again rightly, that commodity prices are moving up. So again here that my horse to cart analogy comes into picture once again, that if just to take an example of say auto, if the interest rates moves up, commodity prices are already up, and if the demand doesn't pick up to the extent, then your ability to pass it on is questionable. And that's where then the companies need to take hit on the margins. While in the case where demand is good, so some of the industries where crude oil is the input, those industries, especially the industries like say paint industry, they have shown that over cycles they have passed it on. So here we need to take as a call as an investor that one, whether this commodity price will remain here or not is the first question. Whether they can pass it on, in which sector. So in a sector where both fuel price is also hurting as well as the raw material price also hurting, so demand naturally may get affected. In such a scenario, the passing on would be difficult. While in some other case where anyway demand is doing well, because of supply constraint or pent up or whatever you call it, in such cases it will be passed on. And so you will see difference. So you will not see a homogeneous outcome that all the companies, because of the raw material prices, the margins decline. It will be selective. And in B2C segment, especially in the consumable segment, we have seen that this company over cycle have passed on. So probably in one quarter, it may get reflected that the gross margins are down. But if you take 1, 2, 3 quarter and then they don't take the price hikes immediately, they take it gradually and then it will be passed on over a period of time. Again, provided the interest rate is not it is not actually reversing the growth cycle.
Thank you, Shreyash, for a very detailed explanation. And what we understood from that was that it's cost leadership which is going to decide the margins going forward if commodity prices remain at elevated level. So my next question is more about large cap versus mid cap over a longer period of time. And I'm not looking at the stock price movement. I'm looking at the revenue growth and EBITDA growth. So if we look at data from FI 2010 to FI 2020, the revenue and the EBITDA growth for mid cap has been 1% higher than large cap over these 10 years. Now my question is this 1% good enough to justify the nimbleness which mid cap companies have, to justify the volatility which these mid cap companies have, or you feel that this 1% will become much higher number going forward?
Definitely, this 1% is not sufficient. That is a straightforward answer is that it has to be higher. But then when we do this analysis, there are multiple parameters in this. The way I was explaining in my one of the earlier answer that one need to look at how these companies change from one bucket to other bucket. That is, most of the time what happens is the mid cap companies, they tend to become large cap if they are performing well. So probably the 10 year ago, the company which was in mid cap today percent weight in Nifty, some of them, the best performing one. And that's where the bigger question means the way I ask question myself, since I do multiple categories, large, mid, multi-cap categories. Uh, when you are choosing any company from large cap top 100 companies or mid cap 101 to 250, that is the mid cap set. What is the probability of winning, right? What is the probability that any mid cap company can become large cap, and what is the probability that any small cap company becoming mid cap? Because when you choose such companies, that is the only way where you really outperform as a mid cap category. So probably when I look at my portfolio, I see that there are many large cap also technically, but then 2 years ago they were mid cap. And actually for me that happening is the best thing to happen, that your mid caps become large cap because they are doing well. And focus on that thing is important to look at, because when we do these numbers, then this thing gets missed. The company which was doing well, it is now my large cap, so now you can't no more count them in your mid cap calculation. Having said that, your observation in another way, if you look at it from the probability of winning, which I was alluding to, in that manner, your observation is perfectly right, that not the probability of winning from mid to large or going from mid to large is not that high. So if you select 150 companies, only few go become large cap, and that number has been low. That is the real issue in my opinion. And why that number has been low is how many mid cap companies are doing different things. Again, I would use again the what I answered in the first question, that orbit, changing the orbit is important. If you are a consumer electrical company, and if in India GDP growth is say 10-12%, and you end up growing 15%, that is not good enough for you to become that company to become large cap. Changing orbit is really important, that from one product to multiple product, from low end product to high end product, from one geography to another geography, or from local manufacturing to exports. Unless this migration happens in these companies, that is the real crux of it. And somehow when you do this analysis, those companies who do it, they become large cap, and then those who don't do, they remain there. And we tend to look at their numbers who don't do it, end up doing it, and end up concluding that no one is working well. But somehow someone who does it, who becomes anyway large cap during this process.
So very nicely explained, Shreyas. And we always wonder how you manage both mid cap and large cap so efficiently. Now we understand a bit of that, because you always look at mid cap also from a probability of winning point of view, that how many of them will become large cap. So anyways, your universe is, or your mind is playing between both the dynamics at one point of time. So I think it becomes relatively easier for you to manage both, which not many people can do effectively the way you have been doing. So now my next question is more about your fund. And if we look at the performance of your fund, if we take time period performance, it's been extremely good. If we look at trailing return for last 5, 7 years, CAGR has been 20% plus. And one good thing about your fund has been that even in drawdown phases, risk adjusted returns have been better. So if you could tell us what are the 2 to 3 key philosophies which you live by, though you mentioned a few of those when you mentioned about quality companies, deleveraged books, and those kind of things. But what are the key philosophies which you live by so that you have been able to achieve these kind of or this kind of performance over such a longer period of times?
So I'll talk about broader at Axis AMC level philosophy and the stock selection criteria, particularly for mid cap, since the discussion is around the mid cap fund. So the broader philosophy has been quality and growth. These terms are very generic in nature. So you may say that it's broadly similar things uh, uh, often talked about. But here, that defining and being true to it or being objective to it is more important. So somehow quality, as I was explaining, the quality means for us high ROE, free cash flow, less debt, and those companies generally comprise most of the portfolio. Because such companies, see, you take two risks. One is the business risk, and second is the management and the company specific risk. Normally, business risk, you in a cyclical manner, you may go wrong. Cyclically, every business goes through ups and downs. At that time, the drawdown in that company or the fall in that company depends on how good quality it is, whether it is debt free, whether the management quality is good, whether there is no corporate governance issues. So these things actually are important during that drawdown period when your business call is not in favor, right? Because any business can go from cyclical downturn, so one can't always exit the stock at the right time and enter at the right time. So these things, that's where the quality helps. And second is being objective about growth, because our observation is market has rewarded growth always. Even if a company which may be a 10p company, but growing at 5%, and another company which may be 20% company and growing at 15-20%, the second company always gives you higher rate. And that's where going right on that 5% growth or 15% or 20% growth is important, and trying to be objective about it is the important factor. So these are the two parameters we particularly look at. And when it comes to mid cap fund, we generally tend to choose the sector leaders in smaller sector, because in the larger sector, the sector leaders are large cap, and in the smaller sectors or in the highly unorganized sectors, the sector leaders are mid cap. So we tend to look at those players. Secondly, the challengers in the large cap, which have their own niche, those companies are there, which generally tend to grow faster than the overall market. And then the consolidator. So these are the 2-3 aspects we take into consideration when you choose companies for mid cap fund specifically.
Thanks, Shreyash, and that really helps. So my next question is again where I'm trying to link your fund and the broader theme. The theme which I'm talking about is PLI scheme, and we have had a lot of reports where people are projecting GDP appreciation or GDP growth contribution from PLI to be in the tune of 0.5 to 1.5% going forward. If I link it to your fund, you have overweight position in consumer durable, and there you have some electronics play also where PLI schemes could be of some advantage. So if we have to broadly understand PLI scheme, how big you think it's going to be a game changer, and is your fund adequately positioned to take advantage of that going forward?
PLI scheme is going to be game changer as far as economy is concerned. There is no doubt on that. It is extremely well articulated, and they are taking good time to decide what and how much to give to various sectors. So that scheme is definitely going to help economy. When it comes to the listed space, then for our sake, economy, then you can play the multiplier effect of that economic growth. But then when it's going to come to the listed space, wherein the direct beneficiaries of that, the direct beneficiary in the listed space can be few. Probably you can't count on the hand. Actually, probably not more than 4 5 one can think of is direct beneficiary. I'm not talking about direct, indirect, direct beneficiaries because of scheme benefited finish period. So there are few, and then there are indirect beneficiaries in a sense that these companies were already doing something that can be in pharmaceutical, chemical, auto ancillary, and various other things. They are already doing well. This scheme helps them to grow even further. Probably such stocks we have in various quantity in various schemes. So this is how we are looking at this. So one is economy benefit. Yes, there is going to be immense, both from the GDP growth and more importantly also from the import substitution point of view and reducing the import skill for India. But when it comes to listed space, then in my opinion, the direct plays are few, while the existing some listed companies may also end up benefited also because of this scheme. While the direct beneficiary will be more in the unlisted space.
That is a very candid response, and I really appreciate that response. So, Shreyas, that brings us to the last question, and that is a question which is often asked in these times when the markets are doing extremely well. So, our investors who invest into mid cap and small cap, they come back to us and say that market is at a high. Do we book profit? Because they have had experiences in the past, especially in small cap and some in mid cap, where they didn't book profit and the market went down considerably, and the drawdowns were extremely significant. So, though investors don't worry too much about booking profit in large cap or index funds, but they get very jittery in mid cap and small cap. Our advice generally to them is that if your goals have been achieved, both in terms of numbers or in terms of your requirements, then you take out the money and there is nothing else which you can do. But other than that, how does an investor decide when to reduce his allocation in mid cap and small cap? Does one follow only asset allocation model in this way, or there are other indicators which can help an investor decide when to take that action?
Frankly, I have a more theoretical answer to it. You may call it theoretical, but I believe in it more so rather than because practically people want to always experience some excitement about buying and selling. So in theory, you can avoid that excitement. That's why I said my answer is more theoretical. Uh, again, you are the best judge of your clients, how much allocation should be in mid cap and small cap. So I would always recommend, in our funds also we do the similar thing. You have in your mind that I want so much percentage exposure. It can be 10%, 20%, 30%, 60% based on the individual, and you stick to that, right? Because of appreciation, or if it is have to changing, it is different story. Then you can think of again changing back. But based on your personal risk taking ability, based on the age, how much long you want to invest, whatever number you have decided at 10, 20, 30, generally sticking to that over that period of time helps, rather than trying to time the market based on whether it is up or down. As in opening remark, your colleague also alluded to the fact that in March, no one would have expected a market to come here. If you would have, I would have come and spoken. I would not have spoken that yes, market can go to 15,000 by next March. I would not have ever have imagined. So in this, that's where the discipline always helps, because timing is very difficult for anyone for to really do, and that too on the sustainable basis. So I would call once or twice one can be lucky, but not always, right? So the probability, again coming back to that, the probability of winning is very low in this, and that's where going by that defined allocation manner would be useful.
Thanks, Chase. And we expected a similar answer from you actually before asking this question, because generally you are a very mathematical and a very quantitative person, and most of your answers have been around probabilities, which is extremely heartening to hear. With this, we come to the end of our conversation, and this conversation was extremely enriching for us on multiple factors. Or if I have to just list down a few learnings which I had from this session, one was in terms of understanding the behavior of mid cap and large cap, because everyone talks about outperformance of mid cap, but nobody gets into the details of explaining as to why mid cap has outperformed versus large cap is because of the financial heavy large cap instead of financials being heavy in mid cap and small cap. Second thing which was very interesting was that quality companies generally have low debt, and even if interest rate goes up, these companies are not going to be impacted because from a financial point of view. Third important point, and which is an extremely interesting analogy, was horse is growth and cart is interest rate, which will stay with us for a very, very long period of time in terms of our recallability of this conversation. One key point which you alluded to when we were talking about commodities was about cost leadership, and there you clearly defined how B2C businesses are going to play out and which all sectors have been able to pass on the increased prices over a period of time to their consumers. Lastly, about how choosing winners is important and how you select stocks, which in mid cap can become large cap over a period of time and add alpha to the portfolio. Last but not the least, one point which I feel is extremely important, not from a stock market point of view, but from a personal and professional point of view for all of us, is changing orbit. And if I have to take one learning from this discussion, I would take that as a learning. And at individual level also, we would try to change orbit. At firm level, we would try to do that. And I think the same thing what you are trying with your portfolio, we will try to do it at our end, both personally and professionally. With this, we come to the end of our conversation. Shreyas, thank you so much for taking out time. And we know it was a busy day for you. Still, you were able to take out time and be here for this conversation for our investors, which I'm sure they're going to find it very enriching. Thank you so much, and really appreciate your fund management practices, your philosophies, and your down-to-earth attitude, where you are approachable and you always answers all the questions with smile without having any hesitation in terms of same questions or similar questions being asked again and again to you. Thank you so much.
My pleasure. Thank you.